Three banks that approve $100,000 with no income proof 2026. 1. The transformation of business credit access. A new lending environment has emerged in which traditional metrics, such as verified revenue, tax returns, and formal financial statements, carry far less weight than the structural integrity of the borrower profile. This shift reflects a recalibration of risk evaluation as banks attempt to maintain profitability while tightening their automated underwriting systems. The central question is no longer whether the business produces revenue, but whether the applicant demonstrates disciplined personal credit behavior, a legitimate business entity, and evidence of reliability. Footnote: this section introduces the structural shift in underwriting and frames the modern bank approval criteria. 2. Why 0% capital exists and why it still works. 0% introductory funding remains viable because banks benefit from interchange fees, long-term interest potential, and expanded merchant relationships. The mechanism provides the borrower with a temporary no-cost liquidity window while ensuring the bank participates in downstream profitability. The misconception is that these offers are charitable. They are not. They are engineered to stimulate spending and long-term utilization. So what does that actually mean? It means borrowers who appear stable, predictable, and creditworthy receive access to capital even in the absence of verifiable income. Footnote: this section explains why 0% capital continues to be offered and why banks use it as a strategic profit tool. 3. The core requirements for modern approval. Banks rely on 5 core indicators. A FICO score above 700 represents stability in repayment patterns. A clean credit report with no derogatory activity within 12 to 24 months signals reliability. Utilization below 30%, and preferably below 10%, demonstrates low dependency on credit. Comparable existing limits indicate capacity to manage larger lines. A business entity aged 6 to 12 months ensures legitimacy and reduces perceived risk. Together, these elements establish borrower competence. The absence of one weakens the entire framework. Footnote: this section identifies the 5 underwriting pillars essential to non-income verified approval. 4. Why most applicants fail under the new rules. The majority of failed applications stem from poor sequencing rather than poor credit. Applicants create brand new LLCs, fail to establish banking relationships, maintain high personal utilization, or apply before sufficient seasoning occurs. The gap between approval and denial is almost never luck. It is structure, timing, and applicant presentation. The top performers followed deliberate timelines designed to mirror low-risk borrower behavior. Footnote: this section explains the structural reasons most applicants are denied. 5. The 3 banks still approving high-limit no-doc credit. Wells Fargo provides dual approval pathways through business credit cards and no-doc business lines of credit, frequently totaling $60,000 to $70,000 when profiles meet core conditions. Truist prioritizes relationship stability and predictable transactional behavior, producing consistent approvals between $20,000 and $25,000. U.S. Bank represents the highest leverage strategy through multi-card stacking under a single inquiry, but only when routed through a qualified relationship banker. Collectively, these institutions form the most reliable triad for accessing $50,000 to $100,000 without revenue proof in 2026. Footnote: this section summarizes the 3 banks most likely to extend high-limit credit without income documentation. 6. Supplementary techniques to increase funding capacity. Manual underwriter reconsideration, branch-level intervention, pre-activation limit increases, and 90-day credit line expansion requests each function as amplification strategies that optimize final credit outcomes. These approaches leverage human discretion to counteract strict automated denials. They also reveal a critical truth. Automation rejects, but humans approve. Footnote. This section describes techniques that expand approval odds and increase total limits. 7. Structural readiness as the prerequisite to all funding. No strategy succeeds unless foundational elements are in place. The business entity must be formed properly, the EIN must be obtained, and the naming convention must avoid flagged industries. Employment status must reflect formal affiliation with the business rather than self-employment. Above all, the entity must season. So what does that actually mean? It means delaying the application increases the probability of approval more than any hack or tactic could. Patience is a technical asset. Footnote. This section emphasizes that structural preparation is more important than speed. 8. The path to fundability and the two applicant profiles. Two categories emerge. Some applicants must first repair credit, season business entities, raise existing limits, and learn foundational credit mechanics. Others already possess the required structure and simply need guided execution. Both paths are viable, but they require different timelines and expectations. The core principle is the same. Fundability precedes funding. Footnote. This section differentiates between applicants who must build fundability and those ready for immediate execution. 9. High-touch guidance and its strategic benefits. Certain applicants benefit from individualized strategic planning, sequential bank targeting, underwriter-aligned application structuring, and direct escalation channels. These elements convert marginal approval odds into near-guaranteed outcomes. The value lies not in shortcuts, but in eliminating uncertainty. So what does that actually mean? It means high-touch guidance substitutes trial and error with precision. Footnote. This section explains why personalized guidance dramatically raises approval consistency. 10. The transformational impact of access to capital. When executed correctly, these strategies unlock $50,000 to $100,000 in accessible capital within a predictable time frame. Such capital enables business creation, operational scaling, asset acquisition, and long-term wealth building without sacrificing equity or incurring immediate interest burdens. The effect is not theoretical. It is measurable, and it is repeatable. Footnote. This section concludes with the practical impact of high-limit funding access.